CVS, a little bit of background on CVS Pharmacy. We're the largest pharmacy chain in the United States. We have over 5,000 retail stores. And with our acquisition of about 1,200 stores last year from Eckerd, we're now in the Fortune 50. So we have sales of over $35 billion. About 70% of our sales come from pharmacy. The other 30% come from the front store. And I am involved a lot in our Extra Care program. We are the only retail pharmacy across the US that has a large loyalty program. We have over 60 million members. That gives us lots of rich customer data, and some of that is used in the work you're going to see today. And on the other side, you see our circular. That's what the heart of this project is about. And for CVS, the circular is a big deal. We're a high-low retailer. We put out a circular every week to over 40 million households. It is by far the lion's share of our marketing spend. So making changes to it, doing anything that's different in it is a big deal. And that's what we're going to be telling you about. So what really was the motivation for this research? We know that as a high-low retailer with a small box and a different business model, we have a different set of situations than mass merchants. But mass merchant competition is something that we are very concerned about today. We were yesterday, and we know we need to be more concerned about it going forward. So for us, particularly in some of our new markets like Texas, mass merchandisers are really the place of choice for customers in terms of health and beauty products. 72 cents of every dollar in Texas for health and beauty is purchased at Walmart and mass merchandisers. And we have a significant price gap on a regular price point of view from mass merchandisers. And so we need to be focused on how we can help close that gap and make sure that we still have a strong value proposition for our customers. And that's really what's underlying this work. So the other thing that we know is, as I said, we are a high-low retailer, and we're not going to eliminate our circular. That is our key tool in the toolbox. So we can't go from a high-low retailer today to just an EDLP retailer tomorrow. We know there are many companies that have tried to do that and they've failed. So this project is an attempt to really look at an evolution of a little bit of movement in that direction in hopefully a thoughtful and deliberate way. So today, this is sort of what our world looks like. A big part of our marketing money and margin dollars are spent on promotions. Very little is invested in keeping our everyday price positions more competitive. And so what we said was, let's assume that we don't have money flowing in from somewhere. We don't have a windfall that we can use to invest in price. We need to think of our marketing spend as a static spend, a certain pie of money or a bar of money, and we're going to think about how to reallocate that in the sense of evolving through this process of more competitive price positions. And in order to do that, we've started with a very extensive look at our promotional program to figure out which pieces are working and which pieces aren't. And those that aren't, we can take that money and use it to invest in lowering our price. And that's the approach that we took. So we went back, and you're going to hear more about this in a moment from Kusum, but we looked at our 2003 promotions at the week store level and established some models and calibrated some models to identify sales and margin benefit across all of them. And the chart that you see here is really a cumulative plot of the sales and margin contribution of every promotion that we ran. So over on this side are the promotions that work the best for us. Those are promotions where we spend $1 in margin and we get $10 in sales back. Over on this side are promotions where we spend $1 and in some cases we actually lose sales, or in other cases we're only getting 50 cents back. So it's this part of the curve that we're going to focus on identifying and taking the margin money associated with these promotions and reinvesting it in price. And I'll let Kusum tell you more about that.
So I'd like to take the next few minutes and tell you about the overview of the research that we did, the pieces of it, the methods, and some of our findings. So the first thing was to put together data for every single one of the 40 million odd promotional events that CVS had in any of its 4,000 odd stores in 2003, and quantify the lift from every one of those promotional events. The promotional event being defined by an SKU in a given store in a given week. Taking that lift and trying to understand what really the net or the truly incremental unit impact of that was meant that we needed to decompose that lift into how much of it was simply being taken cross-sectionally from other brands, non-promoted brands within the store in that same time, the switching piece. How much was stockpiling by consumers who would otherwise have bought some product in this category later in our store, and how much of it is true primary demand for CVS in that store. So getting those together, and also we wanted to try and get an estimate of something that we always hope happens with promotions, which is to say when you bring people in to buy something on promotion, they browse in the store, they buy something else that they wouldn't have otherwise. We call that the halo effect. So we wanted to get that some idea of what that halo effect is as well. Put all of that together and get the net unit impact of the promotions. Bring in the regular and promotional prices and get the net dollar sales impact, and then bring in vendor prices, CVS's own very sophisticated activity-based costing method to get at direct product costs, and bring in vendor funding to get at the net margin impact, figure out what the promotional margins are for CVS and what the regular margins are, and get to the net impact. Putting all of that together for these several million promotions, we found, as CVS expected, that there was very wide variability in the unit sales and in the margin impact. So the next important step was to try and understand why that variation existed. So the next step was to do this meta-analysis to see why there was so much variation across categories, across brands, across promotion types, and across markets, because these are stores that come from a wide variety of markets. One of the outputs of the meta-analysis was to identify the tail end of the categories that Bari showed you a few minutes ago, and identify the most unproductive ones, which were likely candidates for elimination or at least modification. And then in the final stage, to actually conduct a well-controlled field test where those most unproductive promotions were indeed eliminated, and to look at the impact of that elimination and see whether essentially our analysis was validated or not, before CVS took the rather huge risk of taking these changes in promotion and implementing them chain-wide. And then finally, to continue analysis and try and get more ideas about what else could be modified. So I've already said what the magnitude of the data are. Almost 200 or so categories across almost 4,000 stores, about 40 million promotions or so from basically these 5 main departments. What we're going to be showing you today really doesn't include photo processing, because that's really more of a service. So the rest of this, health and beauty, of course, is the core business for CVS. So just to give you a sense of what the magnitude of the data compilation task was, to get this promotion database together, the 2 main staples. The first staple, of course, was point of sale data from every one of these stores for every one of these items and categories. And the second piece of it is the Extra Care panel, loyalty program panel data, which we used essentially to get at the stockpiling component of the promotional lift. Just getting those 2 pieces together meant we needed to get people involved who were willing to cooperate and willing to share information, store managers from all of these different stores, the corporate promotion merchandising group, the IT group at CVS, just simply to get all of these data together and put them in one place and on servers where they could actually be used, and the Extra Care program folks. Then the next pieces were to bring in the margin information and the funding information, and that meant that we needed the folks from finance, we needed all of the category managers who needed to put together all of the different funding, which comes in so many different ways, shapes, and forms. That itself is a feat, to try to understand how all of these numbers of different pies that come from different vendors, how they all tie together, and say, how much did we earn? How much funding did we get from each of the vendors? Then, the consumer price perceptions and other information, which really in some sense was the starting point of this, knowing that something was needed to be fixed, came from the market research group. And of course, finally, the market characteristics, which is market demographics and competitive characteristics in each of these different stores, came from various vendors. So that's the overall view of where the data come from and who are all of the people involved in doing this. Brief little overview of the method. The details are in the report. The baseline methodology here, which is the first step to try and quantify the lift of each of the promotions, is something that CVS has used for a long time. So this is something that we've just continued to use. And just briefly, what this is the average weekly sales in leading or lagging leading or lagging weeks, and the number of weeks you go back or forth depends on how much turnover that item has. That would mean you don't need to go far back too many weeks, and how seasonal the item is, which means you wouldn't want to go back too far because then you lose the seasonality. Putting that together with the actual promotional sales gets us the lift. Very simply, the switching component is essentially saying, in a category, for every unit of promotional lift that you get, if you see the same units increase in the category as a whole, that means you didn't really get any cannibalization. There was no switching. Everything was incremental. To the extent that that beta sub CS is less than 1, some of the promotional lift is actually switching from other non-promoted categories. So that's the switching. I'm going to go through this a little fast. As far as stockpiling is concerned, from the panel data, we were essentially comparing people who bought on promotion with matched groups of people who bought not on promotion, and then looked at the delay in their next visit to purchase that category and tried to get a sense of what the stockpiling piece was. And finally, the halo is kind of a similar thing to switching. It says, for every unit of promotional lift in a whole department, by how much do you see sales in the unit sales in the store increase? And to the extent that that beta is non-zero, you're seeing some sort of a halo effect. So here's the slide that essentially said all that we were showing you there was that the typical promotional discounts at CVS are very similar to what we are all used to seeing, around the 20, 30, 35% range. The typical promotional lifts also are fairly standard. Lift components, let me point out a couple things here. So overall, in all of our promotional sample, you see less than half of the unit lift is due to switching. About 10%, somewhere between 7 and 15% is due to stockpiling, and there's a significant halo effect. In other words, so for example, if you go down there to that 0.565, that says for every unit of promotional lift in a department, you get an additional 0.56 units of something else sold in the store, which is significant. These are just some descriptive statistics for at the unit of analysis of a single SKU in a single store in a single week. What is the net unit impact and the net sales impact? But what I really want to highlight here is that when you look at the net margin impact, the median numbers are negative in all but the beauty category. So essentially, more than 50% of the promotions in terms of a net margin impact are not positive. The interesting thing here is that when you look at what drives net unit impact versus net margin impact, many of the drivers, such as the depth of discount, such as whether it is featured on the front page or not, have opposite effects on the net unit impact versus the net margin impact. And the bottom line is what that is saying is that managing promotions for net incremental units is quite different from managing them for net incremental margin. And that's an important piece. I'm going to go forward and leave you with some of these takeaways that I've sort of mentioned as we've gone along, but idea about what the magnitude of switching is, idea about the fact that halo is significant and it happens to be very strong in the beauty area, realizing that a large percentage of these promotions do have a negative margin, realizing that characteristics that affect net unit lift in a positive way may well affect net margin lift in a negative way, and realizing finally that eliminating a small percentage of the promotions can actually not hurt net sales impact and yet substantially improve margin. And I'm going to hand over to Bari at this point to show you what happened when we took that small percentage of the most unproductive categories and eliminated them in a field test.
Many of the what we call quick hit categories, the places where we were going to stop promoting because the economics were not favorable, fall in one of our departments. And that has created some real focus in terms of whether or not this was a good strategy. That department is one of our core departments, and that's what really led to the field test. The Mercer Consulting Group actually at one point during this discussion process told us that we were probably the most risk-averse company that they had worked with, that most places would take these results that were based on good solid models and implement them because they were solid and there was lots of naturally occurring experiments during the time frame of the data. But because this is so critical, as I said, in terms of a key tool in what we do, and also because it's related to one of our core businesses, we needed to go and test this, and so that's what I'm going to show you. So the field test that we conducted at the end of last year over a 13-week period was set up in 5 different markets, as you can see here. Those markets were selected in a way to represent all of our geographies, so in the end we could feel comfortable that they were nationally representative of our chain. And then we had control store groups for each of those test market groups. So we tested in over 400 stores. We, in a few of the markets, reduced those categories from the circular, and I'll show you some examples of that in a minute. And in other markets, we actually added in some customer-specific offers because we felt that we might need to be concerned about a short-term sales loss that was coming from working through the stockpiling or pull-forward effects. So in these markets, we gave some incremental offers at the customer level during the early weeks of the test to try to take care of any short-term sales loss that would emerge. So let me show you the circulars. And on the one hand, I'm saying this is a big deal, right? Our merchandising group was up in arms. How can we do this? How can we take things out of the circular? This is how we drive sales. We're a very sales-driven organization. On the other hand, what I'm going to show you is when you look at the changes to the circular, it really doesn't feel that significant. And we did do some research with customers to see if they were noticing any differences. So here's an example of the circular that the chain got, the front page, and this is an example of the circular that the test markets got. And if you look really closely, you'll notice that this block is different in this version of the circular. Vitamins was one of the categories that we tested, so all we did was move one of the blocks from the back page to the front page. That was a big, big deal. Here's another example. Stationery is one of the categories that we cut. And so what you can see over here is the circular that the rest of the chain got. The test markets got this circular. We're still showing all of our school supply and stationery items, but with an overall assortment message, no price point. So the real issue here is we can't promote in the circular with a discount because that doesn't work from a strong margin sales point of view, but we can talk about these categories, and that was a way to try to appease some of the merchandising folks. There are actual additional benefits that could come from this that would be cutting the size of our circular, the expense savings that would emerge in that way, but this is really a more conservative approach. All we're talking about is eliminating some blocks. We're keeping the size the same. It's all about just the margin money that reveals itself from this. So what did we expect during the test? We expected that we'd lose some unit volume. Obviously, this is all about switching people, in some cases, to pay full regular retail, but there'll be some loss of promotional units. We expected sales to remain fairly constant, particularly because we were adding in these incremental customer level offers during the early weeks in some of the markets. And the big win was meant we were expecting to see a lot more margin. So what did we see? The key result that we're looking for is over here. So we've got the categories listed here. They're not identified, obviously, and you can see the impact in those categories, the impact in terms of the margin gain coming about in each of those categories, and then the flow through to the total front store, the non-prescription business. So these numbers are projections based on those 400 stores in the test. to the chain. And so what this meant is, based on our field test results, we would expect to lose about $8 million in sales, but we would gain about $53 million in margin. And we are, out of a $35 billion company, about $9 billion on the front store side. So an $8 million sales loss is relatively insignificant. Needless to say, any sales loss is not something that we jump up and down about, but the trade-off given the incremental margin is a good one. And so in terms of these results, what we learned through the process, or what were some of the surprises in terms of the field test and the modeling work, were first that some of our promotions really are generating very little in terms of net incremental sales. And you might say, how could that be a surprise? I mean, we see the results every week. But the results that the merchandising team sees is really the lift on the ad block. So they see big bumps up in particular brand sales in a week when that brand is in the circular, and they interpret that as significant sales gain. Those are the numbers that they were used to seeing on a weekly basis. So the fact that some promotions really weren't adding to overall category sales was a big surprise, and still is a big surprise to some of the category managers. The other big surprise is that the categories where we saw less productivity from our promotions were very often focused in our health categories, our OTC health categories. And that made this work that much more significant and also controversial, because we are a healthcare company. 70% of our sales are on the pharmacy. They're very linked to our OTC departments. So the notion that we would tinker around with the OTC part of the business made this something that was much more significant than it would have been if it was changing our edibles or soda kinds of categories. We also, for the first time, were able to quantify the halo impact of promotions. And if you sit in a normal weekly promotional planning meeting with our merchandising team, where there are debates about what's going on the front page, what's going on the back page, what's making it into the circular, many of those arguments are based on the notion that this promotion in and of itself may not do a lot for my category, but the reason we should have this on the front page is because it's going to bring in a whole bunch of other people, and they're going to buy a lot of other stuff in the store. And those arguments are largely emotional ones, because we never had any measurement prior to this work where we could say, well, we know how much incremental business is going to come in from one promotion versus another. So that was extremely helpful and surprising for some of those departments that have relatively small halo. The halo is much bigger for beauty in terms of the work that we've done compared to health. And that was a big surprise because, as I said, health is our core. Beauty is a second core category, but most of the folks in the merchandising organization would have expected the health categories to really be driving the highest halo. And the fact that we could actually cut some promotions and not have a significant negative sales effect was probably the biggest surprise just in concept. And again, when you look at the details, obviously it makes sense, but when you are not as close to it and you're just sort of delivered that message, it's a very, very surprising one to a big part of the organization. And the notion of being able to kind of, as I said, evolve through this and make some small steps over time in terms of lowering our price and finding money to do that really is what we are focused on through this process. And you might step back and say, well, $53 million for a $35 billion company isn't a significant amount of money, but finding $53 million and figuring out where to get it so that we have it to invest isn't a simple thing. And our executive vice president of marketing and merchandising, when we presented this and sort of had the discussion around, is this enough to get the process going? Do we feel like $53 million is significant? Because we were sort of stepping back and saying, maybe this really isn't big enough. He had completely the opposite point of view. From his point of view, finding $53 million is really the equivalent of finding some new business opportunity in the merchandising group that's worth $250 million. And we don't have those kind of opportunities coming all the time. So this was exciting for the organization in terms of being the first phase. So again, in terms of impact on the company, understanding our promotional plan, really knowing what the incremental sales and margin is a significant outcome of the work that we've shared with you today. That is something that this work was a first stage in really being able to set the framework for now regular reporting that the merchandising team can see that shows them true net impacts. The fact that we could even get to the point of testing this for our company, given our culture and our commitment to our circular, is absolutely testimony to the fact that there was a lot of buy-in for the work that was done. And getting then from the test to the chain-wide implementation was another big hurdle. And we started implementing this across our program in April, so we're about 9 weeks into it, and there is lots of energy and activity around looking at the results that we're seeing across our chain. It's something that all of the category managers involved in these categories that were cut out of the circular are hearing from the suppliers, hearing from the merchandising analysis team, results that they're looking at on a regular basis so that we can decide if there are any reasons to adjust strategy. And we are going into a second phase of testing. We tested just that bottom part of the curve that we looked at. We're working in some test markets to cut the next tranche of the curve, the next phase of the curve, to see what the implications are there, and looking at different approaches. In some cases here, as you saw, we just cut those categories out of the circular, but with this next phase of testing, we're looking at modifying the discount amount, decreasing the frequency, more compromised approaches to optimizing the promotional plan. So just to summarize in terms of the process, it started really with the understanding and clear feedback from customers that we need to improve our everyday price position. In order to do that, what we did was say, we're going to go figure out where we can get some money from the promotional program, test it, implement it chain-wide, and it is accepted today and is still in the process of discussion, as I said, and good, healthy challenges to look at whether or not competitive situations are changing, whether or not anything that our suppliers are doing is changing that would suggest that we should continue to evaluate this. And so I guess the last thing I want to leave you with is that I used to be in the academic world, some of you know that, and as a former academic who did and still does research that's related to real data and real results, for me this is truly a thrilling project, because it is an opportunity where we've taken marketing science, we've used it in a big company, and we've changed how we go to market. And that, if you had asked me before I came into the corporate world, would have been my strongest goal to have coming out of my research. So it's been really fun to be involved in this change process and putting all the models and analytics to work. So I appreciate you taking the time to hear about it.
Can you please elaborate a little bit more about the information and how you get the information from the different departments, how you collected it, and how you transferred and converted it into objective data?
Sure. I mean, we have pretty good data warehouses at CVS. I think it's a strength of our company. So getting the POS data is pretty straightforward. We keep that information. It's in some data warehouses, so it's accessible and used on a regular basis. And the extra care data the customer panel data is also in a separate data warehouse. It has the same category hierarchy as our POS data. So it was a simpler integration than I think it might have been in a situation where we had many disparate pieces of information all over the place. we have relatively good data resources, and it's more about getting those two pieces aligned and getting the computing power to go back and do what we did than really the assembling of the information.
We just add each of those pieces of information is already objective data. So it's not like we had to take subjective measures from individual people and convert them into numbers. The only piece that is not objective, I guess, is consumer perceptions, but perceptions are real. So there wasn't a translation of something non-objective into objective. It was just putting it all together in one place and integrating it.
This fascinating work, but it's almost overwhelming to me. There are so many interesting findings. Could you say these are the 3 big takeaways? Build some intuition for us?
I think that one key takeaway is that need-driven businesses respond less favorably to promotion, which I think is intuitive, but nevertheless really came out of the information. So if I need pain relievers, if I need cough products, if I need first aid products, I'm really not stimulated to come to the store and buy more of it simply because it's promoted. So that is one of the key takeaways, that need businesses they're not as expandable, they don't perform as well, and we see that through the information. I think another key takeaway is that the notion of differential halo is significant. If you look across our business and look at the results, there are really different patterns that come out in terms of the department draw for certain kinds of promotions and then how that spills over into the rest of the store. And that's a meaningful component of how one looks at how a promotion really performs. And the other is, again, this I think is probably obvious to many of the people here, but the switching side of things is also incredibly significant. And to an organization that, as I said, looks at just those 400% lift numbers, 600% lift numbers, because when we promote Tylenol, guess what? Sales for Tylenol go up. And that doesn't necessarily flow through to an overall category impact is another key outcome that comes from the work.
If I could just add one more. When we talk about the profitability of promotions, the issue that always comes up is how much of that lift is truly incremental. And that is the main thing that we think about as driving how profitable the promotion is going to be. That is certainly very true. But there is also a second piece here to the net margin impact, and that is how much is the promotional margin versus the regular margin you would have got. And there is an implicit assumption that many of us always make, that the retailer is making at least as much promotional margin as they are regular margin because the funding comes from manufacturers. But that's not the case in many of these situations. And in fact, in some cases, that promotional versus regular margin piece is almost, in some cases, more important than how much of the impact is truly incremental versus not.
I wonder, because you have so many different parties involved in that project, how you convinced all those people working on that project to get those goals done. Because there are some critical issues.
Yeah, I think it really is just about senior management support. So the project was sponsored by our Executive Vice President of Marketing and Merchandising. So both the promotions team and the merchandising team are under his hierarchy. And he knows from our customer tracking information that price perceptions is an area, and value perceptions, that's a key imperative for the company. So really getting it done wasn't as big of a problem as you might think. We're an organization that does, I think, a pretty good job of setting priorities, setting initiatives, and things that make it on those bubbles as initiatives for the year are the things that get done, and this was one of those key initiatives.
You indicated that you lost $7.8 million in sales, and that's small relative to the whole company number. But have you quantified, are you losing customers?
Uh-huh.
And could that be just a short run 7.8, but in the long run be much bigger?
You sound like one of the people in our merchandising organization, Lee.
Thank you.
We have, because we have the loyalty program data, we did look hard at what this meant in terms of customer loss. There is some loss of customers, and the reassuring part about that is the customers that we lost during the field test are customers that were unprofitable and that were purchasing the majority of their products on promotions. And as you saw, we don't make money on those promotional items. We need people to be buying other stuff because those promotional margins are not ones that would help us be in business tomorrow. So we did lose some. It's pretty small, and it was a comforting kind of view because it was customers that we were more comfortable losing.